And there we go. Okay. Hi everyone,
This
thanks
is
for
great.
coming. Just let me double check and make sure everything looks good. Yeah, everything was great. Okay, thanks everyone for coming. Welcome to my quarterly review, and it has been a week. I was just sharing with some of the people here just now, and Hadas, of course. It's been terrible for crypto. I feel like we've compressed 12 years of financial markets into 1 year, so it's been fantastic. Anyway, I'll share more about that later. But anyway, thanks guys for joining the call. So just to quickly introduce myself, and I do this all the time. So if you want more details, just go back and reference my other videos. But yeah, I have all these qualifications in finance. And the truth is, I don't think any of it matters because I've seen a lot of smart people lose a lot of money. So, and I've seen a lot of people who are very qualified lose a lot of money. So I don't think any of these matter. I trade how I trade my life savings, and my mission is really to make it easy for people to invest in a way that they can trust. Okay, so yeah, one of the things that I'm very passionate about is modern day finance shifts the responsibility of, like, this is, we always say this is not investment advice and things like that, to back to the investor, but for the investor to pick up the required knowledge to exactly learn what we're doing. It seems like a lot of responsibility, and I don't quite like that, because finance is getting more and more complicated. If you are kind of a well-to-do individual, you would have someone to talk to, but regular people don't. So I really started eToro because of this. Okay, so what's really important for me is I want people to do what they're good at. They have full-time jobs. Go and do your full-time job. For finance stuff, it's a really heavy burden to place in someone to say, go and learn how to invest in the market. So that's actually what I'm trying to do. And I really think eToro has the ability to rethink that aspect of finance, and that's why I do this. What's really not important to me is just the number of green months that's up, because all that shows is not really skill, but the track record matters more than that, because it shows the way that they manage their money, as opposed to just green months. Because there are people who have green months, and then one day the system just fails and then they're gone. But yeah, okay. So this is the agenda for today, where we are. So I always go through kind of where we are, the markets. I did the numbers 2 weeks ago, so they're not going to look as good as they do. They look better in the slides than they do now, actually. So I caveat that first. Some disappointments that we have in the market, and here I will talk about crypto because everybody loves it when I talk about crypto. And I'm just going to talk a little bit about diversification and just the 5 major trades that we have on. Okay, and here we go. Okay, so how do we do for year to date or 10 months? We are kind of in between this 10-month and this year to date. When I took this 2 weeks ago, we were down just slightly under 10%. Right now, I checked it today, it's like 11.3 or 11.4, might be 12 now for all I know. The broad indexes are down terribly. So, and we always use this like benchmarking term. I personally don't benchmark, because again, I think benchmarking is only helpful if you understand certain concepts, but I don't think benchmarking is that important. So all the major things are basically down. Like Bitcoin is down, some altcoins are down 80%. So being where we are today, I still think it's a very privileged position. I'm not very happy with it. I think we missed a couple of trades that I felt that could have helped the portfolio. But I can't complain too much because all the markets are down. I wish I was up, but things happen. So actually I have another slide I wanted to share. So if you think about all the events that happened to us since the beginning of the year till now, we were exposed to RSX, which was a Russian ETF. So that dragged our portfolio down something like 6%. So that was major. Chinese meltdown has been absolutely horrible. So, BABA and things like that are just down. I bought it at 50%. This kind of thought it was fantastic. It went down another like 50% or whatever. So that's terrible. Tech has been down. I only have a little bit of tech left, but tech, and crypto goes hand in hand. That was terrible. For crypto itself, we had Luna, which was also terrible for the market. 3 Hours Capital, Singaporean-based firm, terrible for the market. Celsius. There's so many others as well. I think right now we're looking at Genesis and things like that. So there's so much going on in crypto that has went wrong. FTX, this one is let's be honest, it's just outright fraud, and this happened recently, so that's terrible for crypto. Again, I'll share more later. We had rising interest rates, and we have inflation, of course. So these are all terrible factors that happen. And for us to be down like 9, 10, 11% actually is not horrible, but I'm personally not happy about it because I wish I did a little better. But given these circumstances, I think we're okay. Okay, just wanted to share this tweet that I saw. So a lot of people ask, if you know that the market's going down or whatever have you, why don't you time the market, or why don't you short, why don't you hedge and things like that. This is actually a perfect example of why I don't take short positions and why I don't hedge. Yeah, because you can see here that if you miss basically 5 of the best trading days in the year, you would have a probably around 30-40% drop in performance. And this is since 1980 to 2018. And this is based on a Fidelity study, right? So if you miss the 10 best days, your performance would effectively halved. And you don't ever know when the timing is. So I've liked out this portion because I think it's quite interesting. He did follow up. They said there's only one person who can time the market, which is a liar. So great analogy. I love it. And yeah, this is what I'm sharing with you guys. Okay. Yeah, so I'll get the big one out of the way because it's a bit heavy and it's a bit depressing, but what can you do about it? So FTX, this is actually a big blow on crypto, and I'll tell you why. It's really because it was a fraud, and there were a lot of controls around it, and a lot of traditional TradFi people invested in this. So if we look at things like this, you can see that hedge fund says that half its capital is FTX. Multi-coin capital has like assets frozen. SoftBank 100 million crypto position. Sequoia just marked everything down to 0. See, these are big names in traditional finance, and they got burned, right? So these are even like Singapore's sovereign wealth firm, which is called Temasek. They invested in them as well, and they did like 8 months of due diligence and all that, and it still turned out to be a fraud. And this guy was the hero, the complete face of the industry, and it was, it still turned out the way it did, and it's terrible for the market because when we look at the Bitcoin price, like just last year for Hedge, right? It's all-time highs. We know that price is driven by retail, institutional, and leverage. What has happened is that with Three Arrows Capital and by the way, this is all just my personal opinion, so this is how I read the market. I mean, with Three Arrows Capital and things like Luna, we had a lot of leverage in the market because of DeFi, and a lot of people just net long with a lot of like futures products and all that. So there's a lot of leverage in the market. That's one, and all market cycles there'll be a lot of leverage. Number 2 is driven by institutionals, right? So big funds come in, they invest a bunch of money, and that drives up the price as well. And of course, the last portion is retail. So if you think about like that, these 3 blocks brought us to all-time highs. What's going to happen when we're down here, right? Obviously, leverage is not going to come back into the market with the same degree as what it did previously. Institutions, because of FTX and all these big institutions got burned, there's going to be a lot less investment into the sector. And of course, retail, because of Luna, affected a lot of retail investors as well. So that is going to affect investor appetite. And because of all these factors, I don't know when crypto is going to reach that all-time high again. I still have some crypto in the portfolio because I do believe there's some fundamental value within that. But I do see it's going to be a very, very difficult road ahead for crypto. Another slide I wanted to show you guys is this from the Block Research, right? If you look at the amount of investment that went into crypto, like within the past 5 years, you can see here that this trading and brokerage is a big portion. So 3,000 out of 28, and then 7.6 out of 28. So this is really these two are going to struggle a lot, and it's a big portion of the entire investment scheme. So will people be so willing to invest into the space given these factors? I think it's going to be very, very difficult, and it's going to be a very challenging few years for crypto because of it. Does it bring up bring costs back to DeFi? Yes, there are things we can argue around that. But as a general way of looking at the market, the way it is and how it's progressed over the years, I think it's going to be a tough few years. Okay, so I got the difficult one out of the way. So difficult number two. I just want to go over something that just went terribly wrong. So I did update you guys that on 26th of October that I saw that the US Japanese yen was just way overblown, and I thought that it would have contributed well to our portfolio, and I didn't get in because you can see here I completely missed this trade, even though the risk reward was kind of fantastic, right? You look at it, it's from 146 down to 139, and if you kept it upside 155, the risk reward on this is amazing. But I completely missed it because I didn't expect the magnitude that it did. And also because this was really driven by the inflation numbers. I felt that US dollar was too strong, everybody was one side of the boat. I didn't expect the unwind to be so quick. And also, if inflation did well, it would have affected our portfolio. But if it did badly, it would have the stocks in our portfolio have gone down. So I didn't want to add more correlation risk. But I mean, the magnitude of this would have contributed greatly to our portfolio. So something I missed as well, and I kind of wish I caught that. Yeah, so I think I mentioned this during my last investor call that US dollar strength has gone way. Everybody's on one side of the boat. It had to course correct somehow, and it did. And you can see the magnitude of the correction. It was just one day, and it just did all that. And I wish I caught that, but I didn't. But what you're gonna do? You're gonna miss trades in the market. This is just normal. We come to expect this, and so we move on and soldier on. Okay. This is kind of a fun part. I will try not to make it too dry because it's a bit technical, but every time I talk about technical stuff, everyone gives me great feedback. So let's try. Okay, so this is the uni I studied at, and in uni you study a lot of concepts about diversification and correlation and risk, and I hear a lot of people talking about it, right? So, correlation is mathematical statistics, stuff like that. Sometimes you see like models like this, oh, you should put some in stocks, you should put some in bonds and investments and stuff like this. Again, all very academic. And then you can see that, we sometimes talk about this. I talk about this sometimes, systemic risk, what's diversifiable, what's not diversifiable. But I really want to talk about different type of diversification. And I believe this is our advantage, our biggest advantage in being on eToro and looking at the markets and being able to work over a long period of time. Is this concept of diversification by Ray Dalio. So Ray Dalio is one of my favorite authors, and he's the biggest hedge fund manager. He's a hedge fund manager of Bridgewater Associates. And here he talks about this like a holy grail strategy. So he basically said that if you put all your what you call it, stocks into, and they're 60% correlated, like you put everything to US stock tech, for example. If you buy 1,000 stocks that are 60% correlated, they wouldn't provide much more diversification than if you just pick 5 stocks. So whether you pick 5 stocks or 1,000, diversification is exactly the same because of the correlation you picked. Let's say, for example, Bitcoin, Ethereum, Ripple, and then you bought Coinbase. Coinbase is a stock, but your diversification is basically none because the correlation is so high. So what we want, and this is what we try and do on eToro, is 15 to 20 good uncorrelated income streams. So things that are not related to each other, and this could dramatically reduce our risk without reducing expected returns. And this is really how I think it's really one of the superpowers. So I talk a lot about styles on the way that I trade and invest, and I think this kind of feeds into that as well. So this completely by coincidence, we happen to have 22 positions in our portfolio, and I hope most of them are uncorrelated. And if you just look at the top 5 ideas, that covers basically 60% of the portfolio. So really, I wanted to cover the top 5 ideas that we have in the portfolio, because it covers most of it, and also because I believe they're undiversified and will really give you a sense of who I am as an investor and trader. Okay, so yeah, I think I haven't not been this low on cash in a very, very long time. This was again, it was about 2 weeks ago. I think I may have unwound some as well, but I've not had this little cash. I think last year I had like 30% cash or something like that. But yeah, so this is how it is. Okay, So these are the 5 trades that I have that make up these like 62%. As you can see, they're all different types of styles in terms of the way that investing, and you can see that very different asset types as well within that. Previously I had crypto added to this basket, but like I mentioned previously, crypto I think it's going to go through a tough time, so I took that out, and it's no longer one of our largest holdings. It was something like 10-ish%. I brought it down to basically like 1%. Okay, so I'll go with the first one, on-call wire. I have been on this trade for the longest time. It's done very well for us, and really we've done this because I showed this previously, so these numbers are not updated, but from a fundamental valuation point of view, you can see that if I give it like absolutely ridiculous assumptions, it's still at a margin of safety, meaning that the stock is still undervalued, even given our ridiculous assumptions. So I put a 20% discount rate and a negative 10% growth rate, and it still was, margin of safety positive. So when we bought this, it was insane, and I thought it was completely ridiculous, and that's why I pumped in like, I never put in that much into a position, but for wire, thankfully we did, so it's done quite well for us. Yeah, so I hope to find more of these opportunities. So you can see that valuation grade is A, profitability grade is A+, and these are things I look for on Seeking Alpha scanners. And based on just these two requirements on the stock screen, you can see that actually only like five companies. So these are very difficult assumptions to get into, and there are very few stocks that meet the criteria. And of these, I believe one or two I can only invest in on-call wire. The rest are not very comfortable, like Brazil, Petro Brazil, I wasn't very comfortable. And some of these, I think they're not available on eToro, if I'm not mistaken. There's something around that, but basically the criteria is very hard to meet, and there are very few stocks that meet that basket and criteria. So when we find it, it's great, but if we don't, we just wait on the sides and hope that one comes along at some point of time. Okay, so I did want to show this. So I've invested about 6,005 of my portfolio, so it's about 10%. So again, I don't normally pour in so much at one shot, but thankfully it's done well for us. And you can see here that copper is actually come down quite a bit, and we're still at this kind of levels. So it's a great stock. It has very low leverage, so it's not really affected by rising interest rates, and has benefited a lot from the rise of copper. So if copper does have a bullish cycle, which may or may not happen, I do expect this position to continue to do well for us. But I may continue to trim the position based on what we see on the market and how that works. Okay, so moving on. So Silicon Motion is my largest position by a lot. And I'm not that, in terms of probability, I'm not that excited about it, but let me tell you why it's my biggest position. So it was offered to be acquired by MaxLinear. So MaxLinear is another company. It's offered to buy Silicon Motion, and the purchase price has been 114.34. And when I bought the stock, it was really because I thought it was completely ridiculous that, again, given ridiculous growth assumptions based on valuations, we still had a margin of safety at $84. And this was way back then, so these numbers are a bit outdated. Since then, they've taken a little bit of earnings hit because of the CHIPS Act and things like that. But having said that, I still thought it's a great value stock at a great price. And given the business that they're in, I still felt that, it will still continue to grow over the period of time. It may have 1 or 2 bad years, but for these kind of valuations, you always look at the 10-year rate, and the terminal is 10 years as well. So you're really looking at 20-year time horizon. And if on a 20-year time horizon, it looks like it's undervalued, that's fantastic. Okay, so what I wanted to say is that now it's trading at 62, so I'm losing some on the position. And you can see here it's about 15% of portfolio, largest by quite a bit. And yeah, again, we're losing money. About 10% of this is about 10% down. But the interesting thing is it's being offered to be acquired at 114, right? But it's trading down because basically the market is telling you that I don't think they're going to get acquired. And if they're not going to get acquired, what's the downside? So the downside is really about $9. So we can go to, we lose maybe another $9 from here. So go down to 51. So our downside is really about $900 to $1,200, give or take, right? And but our upside, if it gets acquired, is 65%. So you can make about 5,800 to 6,003. This is why we size up the position so much. It's because if it drops, we lose some money, but not a lot. And if it makes money, it makes a lot of money. So I love this kind of risk asymmetries. But yeah, I mean, everyone's like, okay, but what if you are wrong and the market is right? It's so obviously not going to go through because it's China or whatever. Argument to that is if you look at Twitter, clearly, like, no one was expecting Elon Musk to just buy out the company, right? It was trading at 21% discount. So, and it just went through. This is how merger arbitrages work. This acquisition price that is where the market is currently traded. No one expected this to go through, and it did. So it just popped 21%. Given the risk profile of Simo, it's a Chinese-based stock, it's a semiconductor, and people really don't like these two industries right now. Everyone hates on China and everybody hates semiconductors. Yeah, I do think we're being aptly rewarded. And also you have to remember that this is a much smaller company than Twitter. It's only about $1 billion in market cap thereabouts, right? So it's much smaller than Twitter. And because of that, you tend to get a better risk reward return profile, and that's kind of what we're getting with Simo. So this is going to be an interesting one. Again, if it works, I think that'll be great. This is like a 10%. If on the upper ends, it's like a 10% increase in our portfolio, 9% increase in our portfolio. But if it fails, we lose maybe another 1.52%. So I really think this risk reward ratio is insane. So hence why we are so sized into this position and losing money on it, by the way. Okay, so going next into it. Okay, so my next big idea, and I wish I sized more, but you always have this hindsight, is US dollar, right? So I posted this quite some time ago that dollar CHF, which is dollar Swiss franc, heads I win, tails you lose play. So either way, it's kind of really hard for us to do on this trade, right? So what's going to happen is when I look at inflation rates in like what's Switzerland, right? It's just 2%. And everywhere in the world is really high, like 5.9, 6%. And Switzerland is still well under control. And employment rate in Switzerland is very low, 2.2%. So I don't see a real reason for them to increase rates at a very fast pace, and definitely not at the pace that the US is kind of increasing their rates, right? So what happens here is that when we put on position, we get something called refunds because the interest rates in Switzerland is lower than the US. So you get, just by holding positions, let's just say the price doesn't move, you get interest from just holding the position. And that, when I calculated it, was around, let's see, 18% per annum, right? And that's, of course, you have to manage the price and the expectations in between. So we have to go in and out of the positions. When it appreciates, we get out. When it depreciates, we get in, and things like that. But overall, I think if we risk manage this correctly, it's a really good trade to be in because, yeah, again, 18% per annum, where you kind of get that kind of return, is very, very difficult. So I love this trade again. But we just have to risk manage it. So we already made some money off of this trade, and we are putting on more positions. And what we're going to do is we're going to do something called mean reverting strategy. So again, when it drops below where we think the average is, we will buy and then we'll sell when it reaches the top. So we were very lucky when dollar CHF came down. We weren't in it. So now that's dropped, we picked some up. We will just hold a position and hope that we can just carry the interest rates. And if it drops some more, we buy some more and try and manage the prices or the gain and loss based on that. Okay, so that's that. Okay, yeah, and if you're curious about why the inflation rate is so low in Switzerland, this is a great video that I was watching just the other day. Economics Explained, they have this economy of Switzerland, and they explained it perfectly. So, love this trade. Okay, next one is energy, nuclear, and this hasn't changed much. In fact, I used basically the same slides, right? We've had very little investments into new oil sources, and even though we're moving towards green energy. So because of the low amount of investment into the sector, and because drilling has become harder and harder because of ESG and things like that, oil is really there's not been much investment into oil. And given that oil is very inelastic, meaning that whether price goes up or down, you still need to buy oil, you still need to fuel the economy. The likelihood of you of oil disappearing on the face of the earth is small. We are transitioning to green energy, but it's not going to be overnight. It takes a while. I myself, I drive only secondhand cars because I think new cars are just terribly expensive and pointless. So if we look at like older cars, how long is it going to take for even emerging economies to transition fully out of petrol? I think it's going to take a very long time. That's just my view about it. If you talk about like developing economies like Singapore, if you want to do it green energy by 2040, maybe. But for emerging economies, it's going to be much, much more difficult. Okay, so oil is going to be here to stay, but we've had underinvestment into the sector. So I believe that certain oil companies will start looking very attractive. Rig is one of them because I believe that offshore has been very, very unprofitable for many years, and rig has really took the brunt of that. Their stock price has been terrible. They have an absolutely rubbish balance sheet that I would never touch with a 10-foot pole. So you can see here, valuation is C minus and profitability is C. In most cases, I would not touch this like ever. But because of what has happened and the underinvestment, I think they are on a path to profitability. So what you can see here is net income. This is by quarters. You can see the net losses are slowly narrowing over the quarters, and we are kind of close to break even. So I do want to size this position up, but only when it becomes profitable again, then I'll say, okay, then our thesis is correct. We can go into this. But at the moment, I'm still a bit cautious of it, so I'm not too much on it. Other ways we are playing this underinvestment in oil is nuclear and also energy transfer and Sinopec. So I'll talk about Sinopec and nuclear in a bit. Okay, so for nuclear, again, this is the same slide that I showed last time. I think a lot of people have been shying away from nuclear because of how dangerous they think it is. But the fact is, the recent nuclear disasters have been using old technology. So technology has progressed quite a lot since then. And so nuclear looks to be a safer, not as dangerous option as it used to be. And so I think nuclear is going to make a comeback. It takes a very long time to build nuclear reactors. Definitely it takes 4 years versus net gas, which takes I think a year to just deploy. So it's going to take a while. But I do think that people are really turning a corner on nuclear and really looking at it as a clean source of energy, not just a cheaper source of energy, but a cleaner source of energy, which I really like. So I do believe nuclear is going to make a comeback, and we've done this by buying URA, which is the ETF that buys miners. I would prefer to hold this, which is the Sprott Uranium Trust, which holds physical uranium, because miners can be a bit difficult. The biggest position in URA is actually a company, Camco, which I'm not terribly fond of because of a few factors, but there's no other way of getting exposure. So I prefer, that's why we have URA, but if the Sprott comes available, we'll definitely buy the Sprott. You can see here that over this period, I believe this is year to date, URA is actually down 12%, while the Sprott is up 14%. So there's a little bit of gap as well between that, which I think will close eventually. And we should be able to see some profits from it. It should be a good trade. But again, it's going to take some time. And as nuclear becomes a bit more popular, I think this trade will do very well for us. So that's the trade. Okay, Sinopec. Like I mentioned before, I think everybody hates on China. And I kind of understand why. The closure, zero COVID, things like that. But when you look at what Sinopec is, right, you're talking about the biggest nation in the world by population, having a government-owned entity. So you can pull this from the annual report, right? You can see Hedge shares, state-owned shares is 68%, government owns 68% of the company. So chances of it going to zero is very, very low. It's not going to default. So if it's not going to default, is it going to make a lot of money? Well, they are the distributor of China itself. So yeah, I think over a very, very long period of time, they're going to continue to make money. And look at the dividend. It's like 16%. Like, I mean, this is a crazy trade that I think is insane. So valuation and profitability is fantastic. But it's the stock price has not done well, plainly because everybody's just pulling out of China. Sinopec was listed on the London Stock Exchange but got delisted. So we own the Hedge shares, and Hong Kong shares are not as well traded as the rest of the world. So we have this advantage and disadvantage that the dividend is like 16%. I'm not to say I don't like dividends, but because of different tax rulings and things like that. But at 16%, I think it's a no-brainer. We have to go for it. We have to size the position up. If it makes capital, if the share price goes up and this dividend drops to a more logical level, we may sell out some. But at the moment, I'm happy if the stock price just remains absolutely the same and we just get 16% a year. That's fantastic. So this is a no-brainer trade as well. So that's kind of why we have a large position in Sinopec. Okay. Next one, Builder's First Source. Okay. Yeah, Builder's First Source is a great, again, remember the criteria we're talking about, profitability and valuation. Another one that we really, really like is Builder's First Source, and the stock is barely above water right now. It is not doing well. Reason being is that in the US, home builders are not doing well because of the inflation narrative, because of people saying that, next year we're going to go into a recession and things like that. So people are just generally staying away from home builders, which is a logical decision. But having said that, if you look at just valuation point of view, right, the long-term average of the S&P, the PE ratio, which is price divided by earnings, the average over a long period of time is 15 or 16. So average, right? The minimum was 5.31. Builder's First Choice, Builder BLDR right now is trading at 3.47. So it's lower than what you can see as the long-term average. It's undervalued. To me, this is undervalued. It's a great company. It is cash profitable. It's going to be affected by rising inflation rate, but not as much as people think. I was looking at the annual report today. They do have some commitments that are locked in financing for some period of time, so that should help. And I have more to add. Hang on. Oh yeah. Okay, so I want to say recession fears hit, so hence why people are like not so keen on Builder's First Source, and housing market in a recession tends to do badly. But yeah, so what we can see here is that, okay, I'm gonna get to that again. Just lost my train of thought. Okay, sorry, I'll go back to this. Yeah, so what we did is, people are very scared of what happens if we go into recession and things like that. So in order to stress test this, because Builder's First Source has been around so long, you can actually go back and look at 2011, go all the way back to like 2007 and look at how well they did through an economic crisis, right? So that's the global financial crisis. If you go into their annual report and look at it, you can see that basically their sales numbers have dropped by half. So let's just say okay, let's just say Builder's First Source really goes through, it halves, and they don't do as well. How long does it take to recover back then? So, okay, so sorry, gross margins, we talked about 2007, and what happened in 2011, it recovered. So we take 2007 sales, and then it went through the financial crisis. It took 7 or 8 years to get back to the sales number it had before the financial crisis. So if we think about that, that's and gross margins. So gross margins are better because they're currently at 30. What's gross margins? Yeah, current gross margins is at 33%. And sales numbers, if we assume that it just goes back and halves, right? It takes 7 years. So let's just assume a 0% growth rate. You can see here, I assume a 0% growth rate and a 12% required rate of return is still undervalued. Okay, so what this tells you is that, if we go back and look at the history of the company, and we say that it went through a financial crisis, took 6 years, it halved all its sales and all that. And we took it even further and we said they're going to grow by 0 for the next 20 years, right? It's still a discount. So having those assumptions really, really helps because I know that they can make it through a crisis. Okay, and of course, I talked to people on this, and Robert Mudd is one of those people that I've talked to. So if you guys don't know him, he's another elite popular investor, value investor. Great guy, love him. And yeah, we were talking about, how we love Builder's First Source. So yeah, it's a great stock, and I'm not the only one who thinks it. He agrees with me, and he has done a lot of research as well. So yeah, this guy's fantastic. If you guys ever had a chance, go and watch his videos. He's brilliant. Okay, yeah, so I'm done with those 5 big trades, and now we're gonna go into the market outlook, which is where do I think the market is gonna go in the next 3 months, 6 months? And here's my answer, right? Yeah, so a lot of people are saying that it's going to be recession. I showed you the slides just now. People are saying we may go into Stanley Druckenmiller, one of the best macro investors that are out there. He wants it's a high probability stock market just be flat for the entire decade, meaning that we stay at these 3,000, 4,000 level for just one entire decade. 10 years, right? He says, and the people saying, recession may not happen, says Goldman Sachs. And previously I showed you analysts saying that, it's going to be a recession next year. So, yeah. And, there's all these factors going on. So there are major layoffs in all the tech that we know. Banks prepare for consumers to be unable to pay back their loans. So that's negative. So, when they say it's not a slam dunk, it's kind of questionable. But then again, we look at balance of trade, we can see that the US is doing very, very well on the balance of trade. So there's so many factors going into this, and this is my answer for where the economy is going to go in the next 3 to 6 months. I don't know. I don't know. Yeah, one of the reasons that we don't use market data and things like that is because we don't benchmark ourselves, because our job right now is just to make the absolute best return we can, and we do that by making the best decisions. But when it comes to markets, I mean, I really don't know. I have no clue what's going to happen. We just make good choices and at good valuations and things that we think can make money over some period of time. But we're depending on stock market going up or down. It's really hard. I mean, the truth is I don't know. If it goes up, great, our portfolio benefit. If it doesn't go up, I still think we have a good chance of still making money. So that's kind of how we positioned our portfolio. Yeah, so these are the things that we can do. So thesis ideas, if we are correct, we make. If we are wrong, we don't do so much. That's kind of how I try and make my portfolio or have these ideas around it. But losses are inevitable. So like this year, I think we lost a lot on crypto. We lost a lot on Alibaba because I didn't think it could halve, but it did. Yeah, what we're looking for is great valued stock, there's good ideas, and what we're not looking for is all agreements, because let's be honest, it's not very possible. FOMO, I never like to chase trades. So if something is like already up and you chase it, I really don't like doing that. And I don't like momentum-based risk. That means, just depending on the stock to continue going in the same direction. I don't really like those risks. So these are kind of the ideas that I have going forward. My outlook is just basically I don't know. Yeah, and after that, just give a life update. So I did share with you all, we are doing deposits, and I won't be doing any more deposits into the account. I had a problem with this previously because I felt that, even though I put in a sizable amount of money into eToro, it felt wrong because I'm getting quite a bit of PI payments from you guys, right? And I felt that if I didn't match it and put in more money, every time we lost money, I wouldn't feel any pain because I still had these PI payments coming in. So there's this asymmetries which I didn't like, because I'm doing eToro because I really want to help people, and I want to manage your money the way I manage my own money. And the only way I felt I could do that is by putting in more money. But what happened is that there's this whole problems with tax. Every time I brought up the subject and got feedback from people, you can go back and look at my wall. I asked for feedback quite a few times. Says, can I just top it up with a certain amount? And everyone was like, no, I don't think it's a good idea. It's going to put out our sink and things like that. So I kind of understand why. So what we did instead is I'm going to use, well, this is a side project I've been working on, but it's called notadvise.financial. And it's a crypto project. But what we did is we can actually pull balances from my interactive brokers account. And you can see here that I'm going to be putting in the same kind of trades that I have on my eToro as my interactive brokers. So I can size up the positions like quite well. And you can see that I'm adding more to the position, even though that there's no like kind of yeah, so you can see that I'm adding to the positions, but I'm not affecting the eToro, so it doesn't affect your copy, which I think is fantastic. So yeah, I'm working on this project. This is still testing for now, and I'm gonna continue working on this, and hopefully that helps. I mean, I just want to be transparent and honest about portfolio and the way that I trade and the way that I invest my money, so that it's easier for the world. Okay, and that's it. Yeah, if you have any questions, please fire away, and I'm going to meddle my screen so I can look at the Q&A, look at the chat box. Okay. Let's see, any questions? Okay, and I don't think there are any questions for today. If anyone has any questions, always feel free to shout out at me on my wall. Happy to answer any questions and from anyone at any time. But if that's no questions, thank you all so much for joining me tonight. I really appreciate the time. I appreciate you all copying me as well. It's a great honor and privilege to do this. And okay, I think I'm gonna end it there.